A very good afternoon, good morning. Welcome to live market analysis week ahead with myself, Giles Coughlin, Chief Currency Analyst. I'm really looking forward to taking us through the session. Particularly warm welcome to you if you're returning, and if you're new, welcome to our Look Ahead webinar. Nice to have you on board. Don't forget, you can ask questions at any point during the webinar. I'll either answer the questions as we go along, or I'll answer questions at the end of the webinar. If you could let me know you can see my screen and hear my voice okay, that would be great. I've got it coming through okay on my end, but a little bit of reassurance. So, yeah, Johan, thank you very much. Perfect. Good, coming through loud and clear. Well, don't forget, as we're talking through different entries, exits, this isn't a signal trading service, it's an educational provision service. This is what we're going to be looking at. So the workshop webinar for Wednesday is going to be how to trade the SNB rate meeting. That's interesting because the Swiss National Bank have been struggling with a strong Swiss franc for years. Now, the reason this is hard for the Swiss economy is that it's an export economy, and a strong currency makes it harder for your exports. Now, if you look at the moment, the Japanese yen being really weak, that's good news for Japanese exporters. And Japan is a very large export market. You know, you think of Toyota, etc., and these big Japanese manufacturers. A weak yen makes their products more competitive overseas. Now, when we have a strong Swiss franc, it means the Swiss exports, and it has a large export economy. Think of all the Swiss luxury goods, watches, etc., etc. That makes the Swiss goods even more expensive, right? So if prices get too high, then people don't want to buy. So that's the problem the SNB are fighting. Strong Swiss franc hurts their export economy, but investors are attracted to Swiss franc because of things like, you know, Switzerland's been neutral for years, very strong financial sector, and you know, just attracts money. Yeah, you know, really significant. Okay, now your question, Suman, about the Bank of England's rate hike is a really good one, and I want to deal with that there. I want to deal with that straight away, and I'll explain why. Because there was significant reasons that we didn't see pound strength after the BOE interest rate meeting decision, and I'm going to explain to you exactly why that was. And actually, I was encouraging people to go short the pound Australian dollar on the back of a more dovish Bank of England. Now, what we saw, Suman, was a dovish Bank of England. Now, this is important for you to understand. Let's look at the euro pound. Okay. Now, we had the meeting out last Thursday, Bank of England, and we saw the euro pound surge on the Bank of England meeting. So the reason was because that was a dovish hike. Now, if you think about it, going into the meeting, expectations were for the Bank of England to hike interest rates. Let me show you. This is SONIA futures markets. Where are they? Here. Yeah, here's your SONIA futures. I think that's Fed Fund futures. Where's our SONIAs? Here we go. Here's our SONIA futures. Now, this was going into last week. Markets are expecting, you know, so nearly 100 basis points of rate hikes are now expected. Now, before the Bank of England meeting decision, they were expecting almost another extra rate hike this year on the SONIA futures. So when the Bank of England met, if you remember, Bank of England's Cunliffe, and check out my blog, Suman, I talk about this in my blog. In fact, let me just find that for you, because this will help you day to day. I'm just going to pull that up. Get that here. Yeah, here we go. Okay, copy link. Great, I'll just pull this up for us. Now, this was what I published out this morning. Now, read this because this will help you understand it. Because this was on obviously dovish hike, Suman. So not seeing this, okay, and this is not a criticism of you at all, because I totally understand how complicated trading is, I really do, but not seeing this was a major miss, because BOE's Cunliffe, he recognised that the cost to households with further rate hikes would be a problem for the Bank of England. So he said consumer confidence has fallen, and the Bank of England didn't want to be hiking interest rates in a way that slows down growth. And at the end of it, Governor Bailey said, look, he said, he had a little throwaway phrase, says, instead of interest rates being like highly likely, he said they might happen. So all of a sudden, the Bank of England has turned from being really quite hawkish to just pushing back against those hawkish expectations. So it was a clear dovish hike, with Bank of England's Cunliffe not even wanting a rate hike. So remember, what you're looking at when you're trading is you're not looking, it's not as simple as, do you hike rates or do you cut rates? It's a question of, to what extent was the rate hike expected? Now, the situation was, it was expected for the Bank of England to be quite hawkish. Now, they were very dovish. And if you remember that in the February meeting, 4 members wanted a 50 basis points rate hike. Now, in this meeting, everyone was expecting a rate hike, so that's not a surprise. So they hike rates, and that's only what's expected. But then they started to say, we don't want to necessarily be too aggressive. So that's dovish. That's where the euro pound gained out of that meeting. That's what happened there, Suman. I hope that helps. What I'm going to do now is just give us the overall perspective where we are, so we can trade ourselves, get ourselves ready for this week. This is global stocks. You can see you've got the S&P 500 down, NASDAQ, US stocks, DAX, Euro stocks, FTSE 100. Now, stocks recovered from the middle of last week. That was before the FOMC rate meeting. Now, there was a lot of option expiries on the Friday of last week. And typically speaking, when you get these option expiries, you tend to see equity gains shortly before or shortly after these option expiry levels. And once the option expiry is out of the way, it's going to traders sort of step back in. And that's pretty much what happened before the FOMC. Now, the FOMC, the Fed were hawkish, but not so hawkish that they were going to automatically derail growth. Remember, the big picture here is, will the Fed hike interest rates as growth is slowing? Now, if the Fed do that, and this is what markets are worried about, then that will affect the future earnings of companies, and that will affect the future stock price. So imagine you're in the US, okay, and you've suddenly got inflation, and then you've got interest rates. So you're thinking, well, my mortgage is going to go up, and all the goods around me are costing more. It's costing me more to fuel the car. It's costing me more to heat the home. It's costing me more to feed the family. I have less disposable income. Oh, so that means we won't have our Netflix subscription this week. Oh, we won't go to holiday. We won't go on holiday once a year. We'll go on holiday once every 18 months. Or the money that I'd saved up to buy the computer, actually, I'm going to need that for living expenses. So if the Fed hike interest rates, that makes conditions harder for companies, harder for individuals, and that's why most analysts that I'm reading are seeing this as a bear market rally. So you see this correction lower? They're seeing this as a bear market rally. Now, if you are long in stocks, this is not a bad place to take profit. It wouldn't be a surprise to see stocks running up a little bit higher into the end of April, but then many analysts are saying this is a bear market rally, and the medium term, it's not unreasonable to expect some retracements. Now, you might look at this and say, well, hang on, Giles. Look at this dip we had in COVID-19 and look at the way that the market recovered. Aren't we going to see a repeat? The argument against this being repeated is that when markets were down here, and if you look at that fall, that was a pretty substantial fall. Look, 35% drop. Okay, in the S&P 500. And since then, since that 35% drop, we've seen a 55% gain, all right? So huge recovery. But here, remember, when that happened, central banks started cutting interest rates. Governments around the world were using quantitative easing. Governments around the world were using fiscal stimulus to support economies. So that's why stocks could keep gaining and gaining and gaining. Now we've got this drop. We've got geopolitical risk with Russia and Ukraine. We've got the Fed hiking interest rates. The first indications of US growth slowing, even though the Fed are very optimistic about growth prospects. And interest rates starting to rise. So that's a totally different scenario here than it was there. Now, okay, and also if you notice, look, we're only sort of 14% off those highs. And at the moment, we're still only sort of 7% off those highs there. So that's not, that's not bad, really. And the area where the Fed will get worried is about this 22, 23%. This is the level where, usually speaking, when you get sort of 22% falls roughly in the S&P 500, then a recession normally follows. I think, like, I looked at some data from Bloomberg, and in the last sort of like 9 times that the S&P 500 had fallen like 22, 20, 21%, that kind of level, 8 out of 9 times a US recession followed. So this means, like, this is still okay. The Fed's not going to be freaking out by the S&P 500 down 14%, 7%. That's normal swings of equity prices, right? So the question that we have to answer from here is, what's going to happen? Is there enough conviction to say this is definitely a bull market? No. Is there enough conviction to say this is definitely a bear market? No. So I'm neutral global stocks, waiting to see more information. If we start seeing global growth, continuing to slow down, then those analysts calling for a bear market, you'd like to see another leg lower, okay? And the area where I'd say, look, I just buy in for the medium term would be 3,600, 3,700, right? That is the area where the Fed are likely to change policy. So any drops down 3.8, 3.7, 3.6 worth getting into for the medium term, okay? And that would also be like a 20% drop. And don't forget the dynamic that takes place at the moment, which is, as we approach May, generally stock markets move sideways or potentially lower. The main gain in stocks tend to come between November and April from a seasonal perspective. So what I'm trying to say, this is not a great place to be chasing medium-term upside. So if you are trading stocks, make sure you're defining and limiting your risk. Now, there is one exception, the China's A50. This is an exception because there's something totally different happening in China. Now, China's A50, first of all, has fallen 40%, so it's a decent retracement. The People's Bank of China are stating that they will be looking at potentially cutting interest rates. The Chinese government has reassured markets it's looking for stock market stability. So overall, markets are very optimistic that China's going to step in and support. Now look at this reversal bar here. Do you see this very long tall candlestick? Do you look to the left here? See all that space to the left? So you've got space to the left. You've got a bullish reversal hammer bar. The body closes within the body of the previous day candle. Very important. Long tail. You could expect a buying at market, stops below the lows, first test up to that 14,600 region. 14,570 would be the first target. That looks reasonable because market conditions are different for China than they are for the US. And also, we've had a much more serious retracement from, 40% plus from last year's highs. Now, there are still risks. And the main risk to this outlook is Russia's relationship with China. Of course, Russia is isolating itself on the geopolitical stage. China is not like overtly supporting Russia, but is sympathetic towards Russia. So if China continues to be supportive of Russia, there is a risk that China isolates itself with Russia. Say a nation starts saying, look, because China's supporting Russia, we're gonna pull our companies or pull business from China. That could weigh on China's 50 stocks. Also remember, from a geopolitical perspective, China would quite like Taiwan to be part of China again, in a similar way to that Russia quite like Ukraine to be part of Russia again. So what this tells you is that China and Russia sympathize with each other over their geopolitical policy and desire for Taiwan and Ukraine. So there are natural synergy elements between the two nations. So that's the risk. If all of a sudden geopolitical risk fades, China 50 index, medium term, fantastic opportunity, stops just underneath 1200, looking ultimately for a retest back up to 20,000. So over the next sort of 6 to 12 months, that's a nice potential looking trade. So that's the thing to be looking at. So that's stocks. Now, I won't get into the other markets because I want to look at the calendar that we have event. If there's any questions, specific questions you have, you can ask me at the end of the session. We've got Fed Chair Powell speaking. What we're looking here is if Powell starts to get concerned about growth. If we see growth concerns, then we expect 10-year yields to fall, dollar to fall, gold to gain. Okay, that's the one thing. If Fed starts saying worries about medium-term growth, look for gold to gain. Gold is at a technically suitable place to go long as well. Like gold longs at market makes sense. Gold longs at market stops just underneath 1890, looking for a retest up to 1960. That does make sense from a technical perspective. If Powell starts to become dovish about global growth prospects, then real yields will fall because you will see a strong bid come into the US 10-year yields. Remember, the 10-year yields, you see they're moving higher on inflation expectations, but if growth prospects slow, then 10-year yields will drop lower, and that will push gold higher. Now, the bond yield curve between US and 10 years is continuing to track lower. Now, if these go negative, most analysts recognize that as a recessionary indicator. So as long as growth is continuing, the 10-year yields tend to be more focused on medium-term growth prospects. So if Fed Powell's negative about growth, then 10-year yields will sink. So that's the thing to looking out for with Fed Chair Powell speaking. And then gold is a lovely place to go long, stops underneath 1890. If there's a very dovish Powell on growth prospects and looking for a retest up to 1960, that's a definite decent trading opportunity. If we get Powell starting to be negative about growth prospects, remember at the moment he's more positive about growth prospects. And some analysts are saying, well, he's being too positive because there are starting to be signs of growth slowing down. In reality, it's mixed. Some metrics are picking up, some are slowing down. So the jury's still out. Governor Lowe speaking. Now remember about Governor Lowe, we've got a very dovish Reserve Bank of Australia, despite, you know, good jobs data, good wage price index. The RBA wants the wage price index over 3% for them to be confident that inflation is there. Now, what's interesting about the Australian dollar is this. As of last week, and this is just from the report from Financial Source, I work as one of the analysts here. You can see here that the Australian dollar, that very bearish position in the COT report, has dropped about 30,000 plus contracts last week. So a lot of hedge funds, asset managers that were short the Australian dollar have finally, take a while to them to do it, have finally reversed those bearish Australian dollar short positions. So if we see Governor Lowe starting to make more positive sounds about the interest rate hike this year for the RBA, expect that to boost the Australian dollar. Australian dollar has been really boosted, and you just have a look here, and this has been weird originally. It's a learning lesson here, but if you look at the Australian dollar, since the invasion into Ukraine, you see how the Australian dollar has just been surging higher? So Aussie dollar just surging higher on the invasion. Why? Well, the reason is the Australian dollar is called a commodity currency. It's called a commodity currency. So the surge higher in commodities, and a couple of the big exports for Australia, it's like iron ore, coal futures, as they've surged higher, right? That's boosted the Australian dollar. So what that means is the Australian dollar could gain quite significantly if we see a more hawkish RBA, and Governor Lowe would give a heads up to that potentially in a speech. So look out for that. EC Lagarde, what we're looking for from Lagarde is we're looking for recognition that they're going to be more hawkish than they were previously. At the moment, the last ECB meeting, and don't forget, if you want central bank information, go to my blog here. I've got a whole wealth of good articles, but go to Central Bank Watch, and I cover the central bank decisions, and you can see the last ECB rate decision, the Fed's policy decision, and the BOE's policy decision. They're all there, okay? And you can just follow it, as the decisions come in. And I focus, so Sumen, I focus on those big narratives. So you see here with the BOE, I try to give a clue what happened back in the title. It's a dovish hike. I try to really spell out what's been going on so people aren't left in any doubt, okay? Now, the ECB were sort of more hawkish in their last policy decision because, yes, they're going to finish asset purchases at Q3. They've kept 2022 rate hike open, and they could potentially hike this year still. Now, this was in the face of a Russian-Ukraine invasion. They're still looking at potentially hiking. So it tells you how much the ECB are worried about inflation. So if Christine Lagarde shows more concern over inflation than she does over the Russian-Ukraine risk, then expect euro strength. Euro strength against the pound would be a good one. Okay, so euro pound upside does make sense now on a medium-term perspective because there's a slight policy shift from the Bank of England. Now, this is not a trade I'm in because it's not so obvious. But if we saw, a deeper retracement back down to that 0.8300 region, that would be suitable for going long on a swing term perspective. Okay, so price moving back down to that support, that would be suitable for going long euro pound at the moment. Obviously, Christine Lagarde will form another piece of the jigsaw. Right, Chairman Jordan speaking for the SNB. Now that's important ahead of the Swiss decision on Thursday. So Thursday, you got the press conference and the monetary policy assessment on Thursday morning, and you got Chairman Jordan speaking. Now, I did a piece on the chuff here you should read. Make sure you read this. Where is it? Let me just find this article I did up here. I've got to find it. Yeah. Right. This is the most relevant research for you to read right now. Okay, I'm sending it to you again underneath the central bank one, right? Basically, the SNB are looking at the real exchange rate, not just the nominal exchange rate. So when the ECB, they're not just looking at the euro Swiss franc exchange rate, they're looking at the real exchange rate. So what that means is when they make this decision, look for any hints from SNB Chairman Jordan, what they think about the interest rate level now, at the exchange rate level. Now, their current mandate is they say, you know, it's highly valued, right? Now, if you just look at the Euro Swiss franc chart, you can see that the Swiss franc just absolutely gained heavily on that Russian risk. We saw the euro selling off. This is starting to look like a reversal kind of price action here. We got this major support level here, okay, huge support level. But don't just buy from this level. What we want to see is some kind of policy change from the SNB. Are they looking at becoming, are they starting to be concerned about the exchange rate? And when they're concerned about the exchange rate, they buy euros and the dollars, and that supports the euro Swiss franc. So this week, we really want to see what is the SNB's latest policy outlook. That will be just key going forward. Okay, and we want to keep our eye on that. So look for beginning clues on Tuesday, but then we're reading the policy report to see what's the long-term outlook. What do they really think about the current euro Swiss franc rate? On Wednesday, got inflation out of the UK, right? If we get a weak inflationary print, below 6%, if it comes in sort of 5.5% or lower, then that will take the pressure off the Bank of England to hike interest rates, and that should be more negative for the pound. A high reading is what's expected anyway, so that shouldn't be unlikely to move market. So a miss here, you'd expect something like euro pound upside. Also then look at Governor Bailey, see what Governor Bailey thinks about current inflation. And remember, the Bank of England is only hiking rates now to control high inflation. So everyone's expecting high inflation. Then on Thursday, we've got the SNB policy assessment. Also got some data out of the Eurozone. Germany is the most important nation in terms of GDP contribution to the Eurozone. So if Germany's doing well, that's good for the euro. If Germany's doing bad, that's negative for the euro. But at the moment, not obviously tradable because of the Russian-Ukraine risk. We've got ECB policy mandate, but obviously factor it in. Good signs from manufacturing and services in Germany is broadly supportive for the euro. So remember that. Remember that. And then Friday, we've got University of Michigan consumer sentiment revised. So that's unlikely to move markets necessarily. But the worse that is, that's more negative in terms of growth outlook. So University of Michigan consumer, if that takes a significant drop lower, then that is negative for growth. Folks, let's just see. So Patrick, if they buy euro, will it impact the euro US dollar? They tend to buy euro and the dollar, Patrick. So if the SNB sort of say we're going to up our FX intervention, it would be more neutral for the euro US dollar. But they're unlikely to just come out and announce that because of what happened in 2015. Remember, they got their fingers badly burned when they tried, you can see here, they tried to because they really hated the strong Swiss franc, they tried to pin the euro Swiss franc at this level. And so every time the euro Swiss franc came down to 1.2, they bought euros and they bought the US dollar in huge amounts. But eventually they were fighting a market dynamic that they couldn't continue to fight. So they had to stop doing that. And you can see that was catastrophic in terms of market impact. So really what we look for is a way to get into this in the medium term, Patrick, is do they have a policy shift? Are they saying we're going to be, do they start saying we're going to be concerned if the euro Swiss franc goes to 1.0? I know some top analysts on the SHUF are seeing the SHUF still making its way down to 0.9500. So I'm not long euro Swiss franc, but I'm conscious that the SNB could have a policy shift which could suddenly make it more interesting. So the number one thing is don't just buy the euro Swiss franc here because you think, oh look, it's a major support level. It's the Swiss hate the Swiss franc being strong, so I'll just buy it and pop my stops there. Don't do that. in this market because they're not just looking at this rate, they're looking at the real rate of the euro Swiss franc, and that's factoring in inflation. And when you factor in an inflation, it's not too bad for them. Yeah, Stefan, great question. More downside for yen, or is it looking extended? Well, I'll put it this way. I took profits on my New Zealand dollar yen longs this morning. Now, I was long New Zealand dollar yen. We've spoken about that quite a few times on these webinars. And thank you, Stefan, because it's reminded me. Now, gun to my head, I'm expecting this to break through this level. But generally speaking, when you're trading, right, and you go up to these top resistance points, you take profit. You can see here, in an overhead resistance point, that's an obvious place to take profit. Now, I didn't take profit last week. I had my take profit about 81.90. I thought, you know what, let's just try and break through. Let's try and break through this level if we can, right? And I wanted to say 82.50 just be taken out. I wanted to see it blast through. Now, the yen, the Bank of Japan came out last week and they've said, we're going to keep the bond yields pinned. And if you look at Japanese bond yields, it's around that 0% level. And what the Bank of Japan do, Stefan, is they say, we're going to keep it between this plus 0.25 and minus 0.25 band to keep it at what they call the 0% level, right? So they're not worried about it. You can go up and down in this range, but that's essentially what they're doing. We're going to stick with this. Now, what that means is that the yen structurally should remain weak. And the yen has been very, very weak over the last few weeks. If we just take a look here at the yen and we just compare this over the last few weeks, we can see, you know, look, since the start of the year, the yen has been the weakest currency since the start of the year, right? So I still expect the Japanese yen to remain weak, Stefan, because the Bank of Japan, the risk going into last week, remember what I said about the Swiss? The weak yen is good for Japan's exporters, but it's not good for their importers. So what some analysts have been saying is, oh, perhaps the Bank of Japan will worry about the weakness in the yen, and they'll start saying we're going to do something about it. Now, they didn't. They said, Governor Kuroda said, I paraphrase, but he was basically like, we've got no right or inclination to intervene in the FX rate. So in other words, we're not worried about the weak yen. So tick number one, the bond yields are being guarded at this 0% level by the Bank of Japan, right? So that's yen weakness. And look at the bond yields in Japan compared to like New Zealand, 3.18%, Canada, 2.2%, Germany, 0.43%, now in positive territory. UK gilts, 1.59%, Fed 10 years, 2.23%, Japanese, 0.207%. So that structurally keeps the yen weak. The Bank of Japan is not worried about the weak yen at the moment in terms of their importers, because the danger is that could have made it too stressful for them, and the Bank of Japan might have stepped in to help them. Three, and this is a little less well known, but oil markets, when oil prices are high, that weakens the yen. So we've got really high oil prices. So all of that means yen should be a sell on the rallies. But as I said, with that clear technical level, I'm just taking profit on my New Zealand dollar yen longs. But say price drops down to 80, I'm getting right back in, yeah, because that's great level. But I was sort of long from, I don't know, 79.32, I think, something like that. I can't remember exactly. But, you know, you got 270 plus points of profit, so just taking that. And I had, you know, longer positions down here, so, you know, you're sort of 400 or 500 points up. Didn't want to risk it. But gun to my head, I'm expecting further yen weakness, but I don't know if this is going to be a pullback first, Stefan. You know, it's the usual. And when you're in those key levels, Jim, if you notice technically, you know, you get up to these key levels, up, down, you tend to have reversals at these you know, see there. So I wouldn't be surprised to see, but equally I wouldn't be surprised to see a break higher. Now, if I saw a break higher in New Zealand dollar yen, what I'd look for is a bounce, break higher, bounce off and away. Geopolitical event combined with long-time resistance, it might reverse. Well, if you notice, the New Zealand dollar has been gaining on geopolitical risk. Weirdly, Patrick, because the clue's in the name, because it's a commodity-based currency and because it's a long way away from Europe, the New Zealand dollar and the Australian dollar have been seeing gains on the Russian geopolitical risk. So what you can expect here, and this is what gave me the confidence to hold New Zealand dollar yen longs over the last couple of weeks, was the fact that risk on New Zealand dollar yen was gaining, risk off New Zealand dollar yen was gaining. But you're right, that relationship could break down if commodities have a pullback, if the yen suddenly sees safe haven flows, if there's just a bit of a retracement, then you could easily see this retrace violently back. So yeah, that's where we're at, folks. I did see an interesting bit of research, Patrick, where the further a currency away was from Kyiv, the more strength it had. And obviously Australia and New Zealand is a long way away. So if you think about it, if you're an asset manager in Europe and you're thinking, where can I park my money quickly? Do you know what I mean? I want to get out of euros. Where do I go? Obviously the dollar's number one. Then also, like, ooh, with commodities surging, Aussie New Zealand dollar look quite attractive. Okay, folks, been a pleasure as always. Don't forget, I will be and am scheduled to be back on Wednesday for the geopolitical risk event outlook, and we'll be looking at that SMB decision in a bit more detail. Thanks, everyone. I hope you have a very good rest of your trading session, and thank you for attending this FX Week Ahead webinar. I'll just put up here the workshop details. The workshop details are here, and don't forget you can follow me on Twitter. My Twitter handle is Giles Coughlin @CCA. I'll just show you that so you can see it. Sometimes I put up some details on my Twitter handle, and you can see it's here. At Giles Coughlin CCA is my Twitter handle, just down there, and you can follow me along there. I'm also a Southampton supporter, so sadly we lost to Man City on the weekend, which is a disappointment. Folks, take care. Have a really good session. Thanks everyone now. Goodbye.